as you get more indebted, in theory, it should be deflationary, but that only holds up true until the central bank starts structurally monetizing it. And so, I mean, this past decade was not deflationary in the sense that you had pretty big deficits. You had a lot of those monetized. And then whether you look at asset prices going up or we look at consumer prices going up, it depends on where the money's flowing. We've had that more inflationary type of environment. And I think, while we're in this current window where the Fed has room to tighten and to reduce its balance sheet, I think the issue is that when you look out forward, the amount of treasury issuance that's coming to market, one of the Fed's kind of shadow mandates is to maintain some degree of financial stability in the system. And so should you get some sort of treasury malfunction, not insufficient buyers, insufficient liquidity, that kind of thing, I think eventually you would see the Fed step back in. So I expect us to eventually see at least a mild recession. I don't know if it'll be this calendar year or next calendar year, but one thing I've been tracking throughout this, kind of spring and summertime is that, throughout 2022, so many people are focused on interest rates, whereas I think the deficit's not getting quite enough overall focus. So during 2022, we had a narrowing deficit in large part because taxes were much higher that year because they were based on 2021 capital gains and other economic impacts from that kind of boom year. So 2022 is this period where the fiscal expenditures were kind of winding down somewhat, and the tax revenue was winding up pretty well. And so that was kind of a contraction event. There's also Fed tightening. So most things were bad for the markets. Whereas this year, it's almost like we've gone far enough that now we actually have widening deficits again. So on one hand, obviously the COVID era types of stimulus have wound down, but we're still running these background structural 6 to 8% of GDP deficits. And then ironically, as they increase interest rates, they blow out that deficit. And so they put pressure on some areas of the economy, but then these other areas of the economy, wealthy retirees, basically like a bunch of different types of segments of the economy are still spending pretty aggressively. Now, when you look at manufacturing, when you look at the PMIs, when you look at most types of indicators, I think we still generally see deceleration towards a risk of a recession later this year or next year. But I expect it to be kind of mild and certain sectors to be in a recession, whereas others might not be because they're not equally affected. Either you can one metric you can look at is unemployment. So if you have a higher unemployment rate than the average recession, you'd be more in the severe recession camp, whereas if you were a lower unemployment rate than the average recession. An example would probably be the 2001 recession. So even though it was a very bad period for the stock market, by most indicators, the recession itself was mild. Another thing you can look at is year-over-year percent decline in real GDP. So in most recessions, that goes negative year over year. Whereas in the 2001 recession, for example, you actually pretty much just went down to flat year over year. So even though you did have a contraction in GDP, it wasn't severe enough to bring you down to where you were a full year ago. So there's different metrics you can look at to see exactly how deep the recession is. And I think one of the challenges the past two recessions have been unusually deep. And so we're conditioned to think of recessions as these cataclysmic events, whereas they actually occur pretty regularly in history, and most of them are not as severe as the 2009 Great Recession or the 2020 lockdown recession. There are very few bond traders today that will change their opinion on U.S. Treasuries based on Fitch their rating, right? So they're very not a lot of entities say, oh, now that it's AA plus, we're going to treat them differently. So mechanicalistically, it shouldn't be a big deal. But I think it does reflect this kind of broader trend that we're on right now, which is that I think more and more participants over time are seeing the fiscal unsustainability that the government's going through. And so back in 2011, S&P did their downgrade. That was based on a debt ceiling impasse. And back then, there were 4 companies that were AAA. And now there's only 2 that are AAA, but it's still the case today that the U.S. government is now ranked behind 2 U.S. companies in terms of their likelihood of defaulting on you with their bonds. And I think that's actually somewhat reasonable. If we imagine the next 5 years or so, the chance that Microsoft or Johnson & Johnson misses an interest payment is actually probably lower than if there's some sort of process hiccup in Congress and they end up missing a payment or principal, something like that, at least temporarily. And for investors like us that might not hold these levered, it's not a big deal. I mean, if we have to wait 2 extra weeks to get our payment, we might not even consider that a default. But for example, if you're a levered bond fund or you're some other entity where you have liabilities and assets, and these are your assets, if you have a multi-week window of disclarity about when that bond's going to be made whole, that matters. And I think that this is basically showing that there's more cracks in the system, there's less governance overall, and as the deficits widen and as this kind of blows out, I think more and more people are seeing kind of the fiscal unsustainability, even if this particular downgrade doesn't actually matter for any fundamental purpose. When a country has debt denominated in its own currency, it's able to finance things with its own central bank as much as it wants. It's not that default's the issue, unless it has, again, some sort of like policy, unless it kind of does it to itself due to its own conflictedness. So default's not really the issue. It's more about structural inflation or period, like waves of future inflation. So I would say what's unsustainable about it is that the past 40 years, you've had rising debt as a percentage of GDP in the public level, but that was offset by structurally falling interest rates. And the challenge going forward is that, even if interest rates aren't going up structurally anymore, if they're just going sideways from here or they're chopping in a big range, now you don't have that interest rates going down offset for the larger and larger structural deficits. And so now we're seeing them, I think, more directly, that basically as debt as a percentage of GDP keeps going, as our deficits very large relative to typical history, especially history outside of a recession, as those things keep inching up, and as you have structurally higher interest rates, it basically shows that we're kind of stuck in almost like an emerging market type of situation where these deficits are going to keep piling out into the economy, and there's really no will from Congress to address them because they're more structural. They're not based on temporary COVID policies or things like that. They're Social Security, they're Medicare, they're military spending. These are the more structural kind of baked into the cake issues, and I think that's going to basically just pour out over the next 5, 10, 20 years. A couple things can come of it. One is that Social Security could be means tested in the future. And so some people that think they're getting Social Security benefits might not get them because otherwise the whole program might become more structurally problematic in 2030. So you could see mean testing. The challenge right now is that raising taxes or cutting any of these programs is politically unpopular. And so the other way that they can manifest if there's no action on a lot of these different areas is that instead we just get above target inflation compared to what we're used to. So it doesn't mean every year is very high. For example, if you're in a recession or the Fed's tightening aggressively, you can still get a temporary down move in inflation. But I think that we would be in an environment in some ways like an emerging market where there's a background level of inflation that you start to become accustomed to that is higher. And I think that's the kind of world we're entering potentially in developed markets. So we had decades of structural trade deficits, and that accumulated a deeply negative net international investment position. And if you were to start reversing that, if we were to have, say, a weak enough dollar, and we would have a significant enough trend change that we get back to kind of a period of structural trade surpluses or current account surpluses, we could start chipping away at that negative net international investment position. The other way to do it is which is unpleasant, is if U.S. assets perform poorly for a long period of time, whereas international assets perform very well, then the value of Americans' international assets can appreciate faster than the value of the foreign sector's ownership of American assets. And so you can reduce the negativeness of the net international investment position that way. But I think this is going to be a long, multi-decade process to reverse that, which is similar to how we saw the United Kingdom over the past several decades. I think the United States is kind of following the path of the United Kingdom, which is you start as a global empire, then you shift more and more towards being a country that's still very large and powerful economically, but that is not quite in the same status that was before.